There is a question that every investor, every trader, and every person who has ever looked at a market asks at some point. Why do some people consistently make money while most others consistently lose it? It is not luck. It is not intelligence alone. It is not even access to better information. The answer is something deeper, something that lives in the way a person thinks, feels, decides, and recovers. Jack Schwager spent years tracking down the most successful traders in the world, not just people who had one good year or got lucky on a single trade. He found people who had built extraordinary wealth over decades in different markets using completely different strategies. Some traded currencies, some traded stocks, some sat in loud trading pits, some sat alone in quiet offices. Yet they all shared something invisible, something that went beyond charts and numbers. This book, Market Wizards, is the record of those conversations. And what you will hear in this summary is not just what they said, it is what they meant. It is the hidden lesson behind every answer, every story, every quiet pause between words. You are not just about to hear trading strategies. You are about to understand how the greatest financial minds in the world think under pressure, how they handle loss, how they find opportunity, and most importantly, how they stay in the game long enough to win. The journey begins with a man who had nothing but raw instinct and borrowed money, and turned it into one of the most remarkable trading careers ever recorded. Let us begin. Chapter 1. Michael Marcus, the trader who learned through fire. There are people who enter the markets with a plan, and then there is Michael Marcus, who entered with almost nothing and lost nearly everything before he found his way. His story is not a clean success story. It is a messy, painful, and deeply human one. And that is exactly why it matters. Marcus started trading with very little money and even less discipline. In his early days, he would take positions based on tips, on gut feelings that were not really gut feelings at all, but just noise dressed up as intuition. He lost money. He borrowed more. He lost that too. This pattern repeated itself in a way that would have broken most people completely. But here is what separates Marcus from the average person who gives up after a few bad trades. He did not stop asking why. Every loss became a question. Every mistake became a study. He was not just trying to make money. He was trying to understand the market at a level that most traders never bother to reach. This is where most beginners make mistakes. They focus entirely on the result, the profit or the loss, and they skip the deeper question of what the market was telling them in that moment. Marcus refused to do that. He treated every bad trade as a lesson that had a price, and he was determined to learn what he paid for. The turning point came when he met Ed Seykota, a name you will hear again later in this journey. Seykota was already a disciplined, systematic trader, and his influence on Marcus was profound. He showed Marcus that success in trading was not about being right all the time. It was about following a method with consistency and cutting losses without hesitation. Imagine a young chef who keeps burning dishes because he turns up the heat too high. A master chef watches him and says one sentence: "Control the heat before the heat controls you." That single lesson changes everything. That is what Seykota did for Marcus. Marcus eventually developed his own trading style, one that combined technical analysis, meaning the study of price charts and patterns, with a deep awareness of fundamental factors like economic reports and global events. He learned to read markets across multiple layers, not just what was happening, but why it was happening, and what it might lead to next. One of the most powerful ideas Marcus shares is the concept of the big trade. He believed that the truly large profits came not from dozens of small wins, but from finding those rare moments when everything lined up perfectly, when the charts agreed with the fundamentals, when the timing felt right, and then having the courage to commit fully. He said that when you are in a winning trade, you should not be afraid to let it run. Most people cut winners too early because they fear losing the profit. Marcus learned to hold on. This is why this matters in real investing. The big returns in any investment, whether in stocks, real estate, or business, come from the moments you stay in a winner long enough. People who take profits too early never build real wealth. The ones who build real wealth are the ones who learn to manage their fear while a position is moving in their favor. But there is a flip side. Marcus was equally clear about cutting losses. When a trade went against him, he did not sit and hope. He acted quickly. This combination, holding winners and cutting losers, sounds simple. But in practice, it is one of the hardest things a human being can do because every emotion pushes you in the opposite direction. When you are losing, you want to hold and hope. When you are winning, you want to sell and feel safe. Marcus trained himself to do the opposite. If you are starting today, look at your investment history and ask yourself honestly, do you hold on to losing positions too long? Do you sell winners too soon? Most people answer yes to both. That awareness alone is the beginning of real growth. There is also a personal dimension to Marcus's story that is easy to overlook but deeply important. He talked about the periods when his personal life was in chaos and how that directly affected his trading. When he was emotionally unsettled, his decision-making suffered. When he found stability, his trading improved dramatically. The market, in a strange way, became a mirror of his inner world. Imagine a person trying to write a letter while someone keeps tapping on their shoulder. Every distraction pulls them away from the task. Trading under emotional stress is exactly like that. You are trying to make precise, rational decisions while your own inner noise keeps pulling your attention in the wrong direction. Marcus eventually turned a few $1,000s into millions, building one of the most impressive long-term records of any trader interviewed in this book. And when Schwager asked him what advice he would give to traders starting out, his answer was simple and unforgettable. Learn from every trade. Do not let any loss be a waste. This sets the stage perfectly for the next story, because the man you are about to meet took discipline to an entirely new level. He did not just learn from the market, he traveled the entire world to understand it. Chapter 2. Bruce Kovner, the man who saw the whole world as one market. If Michael Marcus taught us that discipline begins after failure, Bruce Kovner teaches us something different. He teaches us that the greatest edge you can have in markets is the ability to see connections that other people miss. Kovner came to trading late and from an unusual background. He had studied politics, economics, and history at Harvard. He had driven taxis. He had worked in political campaigns. He was not a finance person in the traditional sense. And yet, when he discovered futures trading, something clicked in his mind in a way that would eventually make him one of the most successful macro traders in history. Macro trading, for those unfamiliar with the term, is the practice of trading based on large-scale economic and political events. Rather than looking at one company or one commodity, macro traders look at entire economies, at the relationship between countries, at how interest rates in one part of the world affect currencies in another. It requires an enormous amount of knowledge and the mental flexibility to hold many different ideas at once. Kovner had all of that naturally. His years of studying politics and economics gave him a framework for understanding the world that most traders simply did not have. When a central bank in Europe made a policy decision, Kovner could trace the ripple effects across currencies, bonds, and commodities with a kind of clarity that seemed almost like a superpower. Imagine someone who studies weather patterns for 20 years. While everyone around them is surprised by the sudden storm, this person saw it coming 3 days ago. Kovner's broad knowledge of global systems gave him that same kind of foresight in financial markets. But knowledge alone was never enough for Kovner. What truly separated him was his approach to risk. He spoke in the interview about how he always defined his risk before entering any trade. He knew exactly how much he was willing to lose before he placed a single order. This is a concept called position sizing, and it is one of the most underrated skills in all of investing. Most people think about what they might gain from an investment before they think about what they might lose. Kovner did the exact opposite. He decided what he could afford to lose, sized his position accordingly, and then let the market do what it would. This removed a tremendous amount of emotional pressure because he had already accepted the worst-case scenario before it could surprise him. This is where most beginners make mistakes. They enter a position thinking about the upside and then panic when losses appear because they never prepared themselves mentally for that possibility. Kovner's method forced him to be honest with himself before the trade began. He also spoke about the importance of not being emotionally attached to your analysis. Many traders fall in love with their own ideas. They build a case for why a market should go up, and then when the market goes down, they hold on because they cannot accept being wrong. Kovner called this the most dangerous trap in trading. His rule was simple. The market is always right. Your analysis is just a theory. The moment the market proves your theory wrong, you must accept that and move on. Pride has no place in trading. This is why this matters in real investing. Whether you are trading currencies or buying shares in a company, attachment to your own ideas can destroy your portfolio. The ability to say, "I was wrong. Let me exit and reassess," is one of the rarest and most valuable skills an investor can develop. Kovner built his company, Caxton Associates, into one of the most successful hedge funds in the world. His returns over decades were staggering, consistently beating the market through careful analysis, global thinking, and iron discipline around risk. One more idea from Kovner is worth holding on to before we move forward. He believed deeply in the value of being a contrarian, meaning he often made his best trades by going against the popular view. When everyone believed a currency would rise, he looked carefully for reasons it might fall. When a market looked obviously bearish, he searched for signs of a hidden bottom. Contrarian thinking does not mean being different for the sake of it. It means that when a view becomes so widely held that it is priced into the market already, the opportunity has usually already passed. The real opportunities lie where most people are not yet looking. If you are starting today, practice this habit. Whenever you hear a widely shared opinion about a market or investment, stop and ask yourself, what would have to be true for the opposite to happen? That simple exercise will train your mind to see what others are missing. The next trader on our journey is someone who became a legend while still in his 20s. He showed the world that discipline and a systematic approach could turn a small account into millions. And then, in a moment that shocked the trading world, he walked away. Chapter 3. Richard Dennis, the legend who walked away. There are traders who are remembered for their profits. And then there is Richard Dennis, who is remembered for something far more unusual. He is remembered for an experiment. Dennis grew up in Chicago and started trading in the commodity pits as a teenager. By his mid-20s, he had turned a few $100s, borrowed from his family, into more than $100 million. He was known for his ability to hold large positions with extraordinary patience, waiting for trends to develop and riding them with calm confidence. He was, by any measure, one of the greatest trend-following traders who ever lived. But what made Dennis truly famous was a bet he made with his business partner, William Eckhart. The two men disagreed on one fundamental question. Can trading be taught, or is great trading talent something a person is simply born with? Dennis believed it could be taught. Eckhart was not so sure. So they decided to settle the argument in the most direct way possible. They would recruit a group of ordinary people, teach them a specific trading method, give them real money to trade, and see what happened. They called this group the Turtles. The people selected came from all walks of life. Some had financial backgrounds. Many did not. What Dennis wanted to see was whether a clearly defined system, applied consistently, could produce exceptional results regardless of the person applying it. The results were extraordinary. Many of the turtles went on to become highly successful traders in their own right, managing hundreds of millions of dollars and running their own funds. The experiment proved Dennis right. Trading, at least a certain kind of disciplined, systematic trading, could indeed be taught. Imagine a football coach who takes players from different sports and teaches them the fundamentals of the game from scratch. Some become stars. The ones who succeed are not always the most naturally gifted. They are the ones who absorb the system most deeply and execute it most consistently. That is exactly what happened with the turtles. The core of what Dennis taught was trend following. The idea is that markets move in trends, both upward and downward, and that if you can identify a trend early and stay with it, you can capture very large gains. The system defined exactly when to enter a trade, how much to risk, and exactly when to exit. There was very little room for personal interpretation. The rules were the rules. This is where most beginners make mistakes. They want flexibility. They want to override the system when their gut says something different. Dennis knew that the enemy of a good system is not bad luck, but the trader who stops trusting the system the moment it has a few bad trades. Every system goes through drawdowns, periods of loss. The traders who succeeded were the ones who kept following the rules even when it felt wrong. This is why this matters in real investing. A consistent, rules-based approach, even a simple one, will outperform an emotional, improvised approach over time. The discipline to follow a plan, even when your emotions are screaming otherwise, is what separates the long-term winners from everyone else. Then came the part of Dennis's story that surprised everyone. After all his success, after proving his point with the turtles, after years of extraordinary returns, he suffered a significant drawdown in the late 1980s. The markets changed. The strategies that had worked so well encountered new conditions. He lost a substantial portion of the money he was managing for clients. He decided to stop. He returned the remaining funds to his investors and stepped back from professional trading. Some saw this as a failure. But if you look more carefully, it was something else entirely. It was honesty. Dennis understood that when your edge is not working, the right answer is to step back, not to push harder and risk more. That kind of self-awareness is extraordinarily rare. If you are starting today, build a system for yourself, even a simple one. Write down your rules for when to invest, how much to risk, and when to exit. Then follow those rules, even when it feels uncomfortable. The discomfort is not a sign that the system is wrong. It is a sign that the system is working as designed. The story we are about to hear is more intense, more dramatic, and more personal. It is about a trader who combined razor-sharp analysis with the instincts of a predator and became one of the most feared operators in the market. He wore his emotions on his sleeve, but he never let them control his trades. Chapter 4. Paul Tudor Jones, The Art of Knowing When to Strike. Picture a quiet office. On the wall, there is a note. It reads, "Losers average losers." Paul Tudor Jones put that note there himself as a reminder of one of the most expensive lessons any trader can learn. Jones grew up in Memphis, Tennessee, and found his way into trading through a combination of curiosity, ambition, and an almost obsessive desire to understand markets. What he developed over years of intense study and real money trading was something that is very difficult to describe and almost impossible to teach directly. It was a feel for turning points. While most traders tried to follow trends after they were already established, Jones became extraordinarily skilled at identifying when a trend was about to reverse. He wanted to catch the market at the moment of maximum tension, when the price was about to change direction, and position himself to profit from that shift. This is called counter-trend trading, and in the hands of someone without Jones's skill, it can be financially catastrophic. In his hands, it produced legendary returns. The moment that defined his reputation came in October 1987. Jones had studied the 1929 market crash intensely. He noticed that the patterns developing in the stock market in mid-1987 bore a striking resemblance to what had happened 58 years earlier. Using this historical parallel and his own analysis, he positioned himself to profit from a market collapse. On what became known as Black Monday, the stock market fell by more than 20% in a single day. Jones made extraordinary profits. While most investors were in shock, he had already seen it coming. Imagine a navigator on a ship who studies old weather logs. He notices the same cloud formations, the same wind patterns that preceded a great storm a generation ago. While the crew sleeps, he quietly adjusts the course. When the storm hits, the ship is already in the safest position possible. That was Paul Tudor Jones in 1987. But do not mistake this for arrogance. Jones was deeply humble about the limits of his own knowledge. He spoke often about the importance of capital preservation, the idea that your first job as a trader is not to make money, but to not lose money. He believed that if you protected your capital aggressively, the profits would come naturally over time. This is where most beginners make mistakes. They think the goal of investing is to make the highest possible return as quickly as possible. Jones taught that the real goal is to stay in the game. A 50% loss requires a 100% gain just to get back to where you started. Protecting capital is not a conservative strategy. It is the most intelligent strategy. His approach to managing losses was almost ritualistic. He would never allow a position to move beyond a certain point against him. The moment a trade started behaving in a way that contradicted his reasoning, he would exit. No arguments, no hoping, no waiting to see what happens tomorrow. Out. He also spoke beautifully about the importance of mental flexibility. He could change his entire view on a market within a single trading session if the data demanded it. He had no loyalty to his previous positions or opinions. Each day was a fresh read of the available information, and his conclusions followed the evidence, not his ego. This is why this matters in real investing. The ability to change your mind quickly, without shame or hesitation, when new information arrives, is one of the most powerful investing skills you can develop. It requires a kind of personal security that comes only from separating your identity from your investment positions. Jones also built Tudor Investment Corporation into one of the most respected macro hedge funds in the world. His combination of deep historical research, pattern recognition, and aggressive risk management created a model that many others tried to copy, but few could replicate. If you are starting today, develop the habit of setting clear exit points for every investment before you enter. Know in advance the point at which you will accept that you were wrong and move on. This single habit will save you from the most common and most costly mistake in investing. Before we leave this chapter, there is something worth noticing about the pattern connecting Marcus, Kovner, Dennis, and Jones. Each of them had a different style, a different background, and a different market focus. But every single one of them shared an absolute commitment to managing losses. They all understood that the way you lose money is more important than the way you make it. The next trader on our journey took a completely different path. He lived in a smaller city, traded an instrument that most people associated with large financial institutions, and proved that great trading is not about where you are, but how you think. Chapter 5. Gary Bielfeldt. Proof that geography does not create genius. There is a quiet assumption in the financial world that the best traders are in New York, in London, in the great financial centers of the world. Gary Bielfeldt quietly destroyed that assumption from an office in Peoria, Illinois. Bielfeldt made his fortune trading United States Treasury bond futures, one of the most liquid and competitive markets in the world. This is a market dominated by large banks, major institutions, and highly sophisticated professional traders. And yet, Bielfeldt, operating far from any financial center, built one of the most impressive track records in this market over many years. His approach was patient, disciplined, and built on a deep understanding of the long-term cycle of interest rates. While other traders moved in and out of positions frequently, chasing short-term opportunities, Bielefeld took large positions based on his fundamental analysis and held them with remarkable patience. He had a saying that captures his entire philosophy. You have to be willing to sit with a position and give it room to work. Most traders cannot do that because they are too focused on the daily or weekly movement of prices. They see a loss building and they panic. They see a small profit and they rush to lock it in. Bielefeld trained himself to look past the short-term noise and stay focused on the large picture. Imagine a farmer who plants a crop in spring. Every week, someone comes to the field and says, "Nothing is growing. You should pull it all up and try something else." But the farmer knows the season. He knows what he planted. He knows the conditions are right. He waters, he waits, and by harvest time, the field is full. Short-term panic would have destroyed the crop. Patient understanding of the process allowed it to flourish. This is where most beginners make mistakes. They treat every investment like a day trade. They check prices daily, sometimes hourly, and react to every movement with anxiety. This constant reaction to short-term noise is one of the greatest destroyers of long-term returns. Bielefeld also emphasized the importance of position sizing. He would build into a position gradually, starting with a smaller size and adding to it as the trade moved in his favor. This approach, often called pyramiding, allowed him to increase his exposure to winning trades while keeping initial risks small. This is why this matters in real investing. Most people add to losing positions because they average down, hoping the price will recover. The truly disciplined approach is the opposite. You add to winning positions and cut losing ones. This simple inversion of instinctive behavior is one of the most powerful principles in all of investment management. Bielefeld's story also carries an important message about independence. He did not need to be surrounded by other traders to succeed. He did not need the energy of a trading floor or the validation of colleagues. He had his analysis, his rules, and his discipline, and that was enough. If you are starting today, remember that you do not need to follow the crowd or be where the crowd is. You need a clear method, the patience to apply it, and the courage to hold your position when everyone around you is doing something different. That combination, available to anyone, anywhere, is the real foundation of investment success. We have now spent considerable time in the world of futures and currencies, learning from people who built their fortunes by following trends, understanding global events, and managing risk with extraordinary precision. Now we turn to a different arena, the stock market. And the first person waiting for us there is someone who built his entire strategy on one unusual concept. He called it variant perception. Chapter 6. Michael Steinhardt. How to think differently and profit from it. Michael Steinhardt did not just want to be a good investor. He wanted to be a different investor. Not different for the sake of novelty, but different because he understood something fundamental about how markets work. Markets are efficient for a very simple reason. They reflect the collective opinion of every buyer and seller at any given moment. When millions of people are all looking at the same information and forming similar opinions, that opinion gets priced into the market almost immediately. If you are simply agreeing with the consensus, you are not finding an opportunity. You are arriving after the opportunity has already gone. Steinhardt's concept of variant perception was his answer to this problem. The idea is that to make exceptional returns, you need to have a view that is not just correct, but meaningfully different from what the market already believes. You need to see something that others are not seeing yet, or weight the same information in a way that leads to a different conclusion. This sounds abstract, so let us make it concrete. Imagine a company reports earnings that are slightly below expectations. The market sells the stock. Most investors look at the miss and agree, this is bad news. Steinhardt would ask a deeper question. Are these numbers actually bad relative to the long-term health of the company? Is the market overreacting? Is the fundamental story of this business still intact? If his analysis said yes to all of those, He would buy the stock that everyone else was selling. His view was variant, and if he was right, the returns were exceptional. This is where most beginners make mistakes. They wait for the consensus to form and then join it, which means they are almost always buying high and selling low. The investor who develops variant perception has the courage to act before the consensus catches up. Steinhardt ran his fund for decades with extraordinary returns, compounding at rates that placed him among the greatest investors of the 20th century. He was known for being intensely analytical, deeply curious about economics and business, and sometimes brutally demanding of the people who worked with him. But his investment results spoke for themselves. He also spoke about the importance of time horizon. Variant perception is most powerful when you are willing to wait for the market to eventually agree with your analysis. If the consensus is wrong today, it may take weeks or months, or even longer, for the market to recognize that. You have to be comfortable holding your position through that period of disagreement. This is why this matters in real investing. The best investments often feel wrong in the short term. They feel uncomfortable. They require you to hold a view that the majority of people disagree with. The investors who can tolerate that discomfort and who are right in their analysis are the ones who build generational wealth. If you are starting today, develop the habit of asking why the consensus view might be wrong. Not because you want to be contrarian for its own sake, but because the most valuable opportunities usually hide in the space between the market's current belief and reality. Our next conversation takes us into a very different kind of thinking, away from macroeconomics and global analysis, and into the world of charts, patterns, and the specific behaviors that winning stocks display before they make their biggest moves. Chapter 7. William O'Neill, The Science of Finding Winning Stocks. William O'Neill built an entire system for identifying stocks that were about to make major moves upward. His method, known as CANSLIM, is one of the most widely studied stock selection frameworks ever created. And it came not from theory, but from an exhaustive study of history. O'Neill spent years going back through market records, identifying every stock that had made a major move over the previous decades, and then analyzing what characteristics those stocks had shown in common just before they broke out. He was essentially asking the market to tell him what winning looked like. What he found was a remarkably consistent set of patterns. Winning stocks almost always showed strong earnings growth, both recently and over the past few years. They were usually in strong industry sectors. They had been bought heavily by institutional investors, meaning the large funds and professional money managers whose buying power actually drives stock prices, and they showed a specific kind of price and volume pattern on their charts just before the big move began. CANSLIM stands for 7 specific factors: current earnings growth, annual earnings growth, new products or management or price highs, supply and demand in the stock, leading industry position, institutional sponsorship, and market direction. Imagine a wine buyer who has studied thousands of great bottles over a lifetime. She has learned exactly what characteristics, the soil, the climate, the grape variety, the fermentation process, are present in every exceptional vintage. She does not hope to find a great wine. She knows what to look for, and she finds it. O'Neill applied the same kind of systematic observation to stocks. This is where most beginners make mistakes. They buy stocks based on stories they hear or names they recognize. They do not do the analytical work to understand whether the business behind the stock is actually growing in a way that justifies the price. O'Neill's method forces you to look at the numbers and the charts together, removing emotion from the selection process. One of his most important insights was about market timing. O'Neill believed strongly that you should only be buying stocks when the overall market is in an uptrend. Trying to pick individual winners in a declining market, he argued, was like swimming against a powerful current. Even the best stocks struggle when the broad market is falling. He developed specific methods for reading what the overall market was doing, using the behavior of major market indexes and the volume of trading to determine whether conditions were favorable for buying. This combination of stock selection and market timing gave him a powerful edge. This is why this matters in real investing. Even a great business can see its stock fall in a broad market decline. Understanding the overall market environment is just as important as understanding the individual investment. The investor who ignores this is vulnerable to losses that have nothing to do with the quality of their analysis. O'Neill also wrote a book of his own, How to Make Money in Stocks, which has sold millions of copies and introduced the CanSlim method to investors around the world. He founded Investors Business Daily as a resource specifically designed to help individual investors apply his approach. If you are starting today, learn to look at both the chart and the fundamentals of any investment you are considering. The chart tells you what other investors are doing with the stock. The fundamentals tell you what the business is actually worth. When both point in the same direction, you have a much stronger case for an investment. Now, we turn to someone who combined O'Neill's approach with his own refinements and developed an extraordinary ability to identify the right moment to buy. He was one of O'Neill's own stock-picking contest champions and a living proof that the method worked in real hands. Chapter 8. David Ryan, Where Value Meets Momentum. David Ryan learned directly from William O'Neill and then took that education and pushed it further. He became one of the most successful practitioners of the CanSlim approach, winning the United States Investing Championship 3 times in a row with extraordinary returns. What distinguished Ryan was his ability to combine the disciplined selection criteria of O'Neill's system with an acute sense of timing. He did not just identify great stocks, he identified the precise moment when those stocks were ready to move. The concept he focused on was what technical analysts call a base. A base is a period in a stock's price history when it consolidates, moving sideways or in a narrow range after a previous advance. Think of it as a stock catching its breath. During this period, weak holders sell and strong, conviction buyers accumulate shares. The base builds what technicians call a launching pad for the next move upward. Ryan became expert at reading the quality of these bases. Not all consolidations are equal. Some are healthy and tight, showing that the stock is being held by confident investors who are not eager to sell. Others are loose and choppy, showing that there is a lot of uncertainty about the stock. Ryan learned to distinguish between the two and act accordingly. Imagine an athlete preparing for a race. Some athletes warm up efficiently, building energy and focus. Others warm up sloppily, their movements uncertain. An experienced coach watching from the sidelines can tell long before the race who is ready and who is not. Ryan developed that same kind of trained eye for stocks. This is where most beginners make mistakes. They look only at price and ask whether the stock is cheap or expensive. They do not look at the pattern of trading behavior over recent months, which tells you far more about what is likely to happen next. Ryan's approach required learning to read charts not just as lines on a page, but as records of human decision-making. He also spoke about the importance of acting quickly once a setup appeared. A good base that breaks out on high volume, meaning more shares are trading than usual, is a signal that institutional money is moving in. That is the time to act. Waiting to see if it will keep going is a mistake, because by the time the move is obvious to everyone, the best entry point has already passed. This is why this matters in real investing. Timing your entry is just as important as your selection. An excellent company, bought at the wrong moment, can still generate poor returns for years. Developing a sense of when, not just what, is one of the marks of an advanced investor. Ryan also showed tremendous discipline in cutting losses. He would never allow a stock to fall more than a small percentage below his purchase price before selling. This ruthless protection of capital meant that his losing trades were always small, while his winners were large. The mathematics of that approach over many trades produced exceptional compounded returns. If you are starting today, study the price charts of successful stocks over the past decade. Notice how many of the biggest winners spent time consolidating in a base before making their major moves. Learning to recognize that pattern will give you a significant advantage over investors who pay attention only to the fundamental story of a business. We have now seen two powerful frameworks for stock investing: Steinhardt's approach of finding where the consensus is wrong, and O'Neill and Ryan's systematic identification of growth stocks at the right moment. Now we move into a section that brings together traders from different worlds, and the first one we meet is one of the most colorful and entertaining characters in this entire book. Chapter 9. Marty Schwartz, The Transformation of a Loser into a Champion. Marty Schwartz lost money for 9 years. 9 years of analyzing stocks, making trades, and watching his account shrink. 9 years of applying the fundamental analysis he had been trained in, believing it would eventually work, and being consistently wrong. And then, something broke open. He discovered technical analysis, the study of price charts and trading patterns, and everything changed. He went from consistent loser to consistent winner in what felt like almost no time. He became so successful that he won the United States Trading Championship, a competition where participants trade real money and results are audited, an extraordinary 11 times. What happened? How does someone go from losing for 9 years to becoming a champion trader? Schwartz's answer is both simple and profound. He stopped arguing with the market and started listening to it. Fundamental analysis, the approach he had been using, involves deciding what an investment should be worth based on earnings, assets, and economic conditions, and then waiting for the market to agree with your valuation. The problem is that markets can disagree with correct fundamental analysis for a very long time. They can stay irrational longer than most investors can stay patient. Technical analysis operates differently. It simply asks, what is the market doing right now? Where are prices moving? Where is volume concentrated? What are the patterns suggesting about future direction? It does not argue with the market. It follows it. Imagine two people lost in a city. One has a detailed knowledge of urban planning and argues that the road should go in a certain direction based on how the city was designed. The other simply looks at the actual streets in front of them. In most cases, the one following the actual streets gets where they are going faster. That is the difference between fighting the market and following it. This is where most beginners make mistakes. They become emotionally committed to what they think an investment should do, and they refuse to accept what it is actually doing. The market owes you nothing. It does not care about your analysis. Price is the final arbiter. Schwartz also developed a very clear set of rules for his trading. He would not trade against the trend of the market. He would always define his risk before entering a position. He would never add to a losing trade. And he would take partial profits on winning trades while letting the remainder run. These rules sound simple, but applying them with perfect consistency required enormous mental discipline. Schwartz was honest about the fact that ego had been his greatest enemy during his losing years. He had wanted to be right more than he wanted to make money. Once he accepted that being right and making money were not the same thing, everything changed. This is why this matters in real investing. Your goal is not to have correct opinions about markets. Your goal is to preserve and grow capital. Those are different objectives, and confusing them is a very expensive mistake. The ability to be wrong quickly and cheaply, and right slowly and expensively, is the mark of a professional. One personal habit of Schwartz's is worth mentioning separately. He meditated every day before trading. He used this time to clear his mind of any emotional residue from previous trading sessions, any frustration from losses, or excitement from wins. He entered each trading day fresh, without the emotional baggage that most traders carry unknowingly from session to session. If you are starting today, Develop a ritual before making any investment decision. Take time to clear your head. Ask yourself honestly whether your thinking is being influenced by recent wins or losses. The cleaner your mental state, the better your decisions will be. The person we meet next made his living in one of the most intense environments that exists in the financial world. Not behind a screen in a quiet office, but in the middle of a trading pit, surrounded by screaming people, making decisions in fractions of seconds. Chapter 10. Tom Baldwin, the fearless mind in the noise. Tom Baldwin walked into the Treasury bond pit at the Chicago Board of Trade with almost no money and no formal training in finance. Within a few years, he was one of the largest individual traders in that pit, moving positions so large that his actions could move prices. The trading pit is a world that has largely disappeared today, replaced by electronic trading. But in its time, it was one of the rawest and most competitive environments in finance. Traders stood face to face, shouting bids and offers at each other, using hand signals and voice to execute trades in fractions of seconds. There was no time for lengthy analysis. Success required instant pattern recognition, emotional control under extreme pressure, and an almost animalistic read of the crowd around you. Baldwin excelled in this environment because of one quality above all others. He was not afraid to be wrong. In a pit environment, you had to be willing to take a loss immediately and without hesitation. Any delay, any moment of hoping a bad position would turn around, and you could find yourself carrying a significant loss into the close of the day. He approached every trading session with complete openness. He had no predetermined views about where the market should go. He simply watched the flow of orders, listened to the rhythm of the pit, and responded to what he saw. When conditions were favorable, he traded heavily. When conditions were unclear, he stepped back and waited. Imagine a surfer studying the ocean before paddling out. An experienced surfer does not force waves that are not there. They read the water, identify the right set, and then commit with full energy and skill. Baldwin had that same patience combined with explosive action when the moment arrived. This is where most beginners make mistakes. They feel compelled to always be doing something, always be in a trade, always be active. Waiting, which is actually one of the most powerful things an investor can do, feels uncomfortable. But the best opportunities come to those who are patient enough to wait for them. Baldwin also demonstrated that formal education and financial credentials are not prerequisites for investment success. What matters is the development of genuine skill, built through real experience, honest self-assessment, and the willingness to keep improving. This is why this matters in real investing. You do not need a degree from a prestigious university or a background in finance to become a successful investor. You need curiosity, discipline, and the willingness to learn from your mistakes faster than the market punishes you for them. If you are starting today, do not be intimidated by the complexity of financial markets. Start with what you can understand. Learn deeply in one area before expanding to others. And remember that the most successful traders and investors are not the most educated, they are the most disciplined. Our next story moves from the chaos of the pit to the precise, strategic world of options trading. And it features a trader whose early career read like a series of disasters that somehow ended in mastery. Chapter 11. Tony Saliba, Patience, Precision, and the Power of One. Tony Saliba's early career in options trading was defined by one catastrophic experience. He was caught in a position that moved sharply against him, and he found himself in a hole so deep that many people would have left the industry entirely. He was young, he was leveraged, and the loss was staggering relative to his resources. He did not leave. He fought his way back, one carefully managed trade at a time. What emerged from that experience was a trader of extraordinary precision. Saliba became one of the most respected options traders in Chicago, known for his ability to manage complex positions with a patience and attention to detail that seemed almost superhuman. He made his early reputation trading one lot at a time, meaning one contract, the smallest possible unit. While other traders swung large positions trying to make big money quickly, Saliba focused entirely on understanding the mechanics of every trade, learning the behavior of options pricing in different market conditions, and building his skill without risking more than he could afford to lose. This strategy of intentional constraint, choosing to trade small while you are still learning, is one of the most powerful and most ignored principles in all of trading and investing. Think of it this way. Imagine a medical student who wants to become a surgeon. The goal is ultimately to perform complex operations, but no one would want a student practicing on real patients with full surgical complexity from day one. The learning process requires a controlled environment where mistakes can happen without catastrophic consequences. Saliba applied that same logic to trading. This is where most beginners make mistakes. They try to make large amounts of money before they have developed the skill to deserve it. They take on positions that are too large for their current level of understanding, and when those positions move against them, the losses are severe enough to end their trading journey before it has really begun. Saliba's story proves that the path to large profits runs through small, precise, disciplined steps. Every trade he made while trading small was a tuition payment for the mastery that came later. And when he had accumulated enough knowledge and demonstrated enough consistency, he scaled up with the confidence that came from genuine competence. He also spoke about the importance of building a support network. He credited mentors and colleagues who helped him understand options mechanics at a deep level. He was not too proud to ask questions or to admit what he did not know. That intellectual humility was a key part of his development. This is why this matters in real investing. The wisest investors are almost always the most curious ones. They read constantly. They seek out people who know more than they do. They ask questions. They treat every piece of new knowledge as an asset, because in markets, what you know is ultimately what you earn. If you are starting today, commit to starting small. Not because you lack ambition, but because learning the game while the stakes are manageable is the fastest path to the stage where you can play for large stakes with skill rather than luck. The next trader we meet is perhaps the most philosophical figure in this entire book. His words go beyond trading strategy and touch something deeper, something about the relationship between the human mind and the markets it inhabits. Chapter 12. Ed Seykota, the Trading Tribe and the Mirror of Markets. Ed Seykota is the trader's trader. He was one of the very first people to develop computerized trading systems, automating the rules-based trend-following approach in the 1970s when personal computers were in their infancy. His returns over decades were among the best ever recorded. An account he managed from the early 1970 era grew by thousands of percent over the following years. But when you talk to Seykota, the numbers are not what he wants to discuss. What he wants to talk about is something far stranger and far more interesting. He wants to talk about why people do what they do in markets. His most provocative idea is captured in one sentence. Everybody gets what they want from the market. This sounds wrong when you first hear it. Surely no one wants to lose money. Surely people who trade poorly and lose would prefer to win. But Seykota argues that at a deeper level, the market acts as a mirror. It reflects the investor's true beliefs, true fears, and true desires, even the ones they would never consciously admit to. Some people, he argues, are unconsciously attracted to the drama of markets. They do not really want the quiet discipline of consistent profits. They want the emotional experience of highs and lows, of spectacular wins followed by devastating losses. The market gives them exactly that. Others are unconsciously afraid of large success and will find ways, subtle and not so subtle, to undermine their own winning trades. The market obliges. This sounds like psychology, not investing. But Seykota insists they are the same thing. The biggest obstacle to profitable trading is not a lack of information or technique. It is the trader's own emotional programming. Imagine two people who both learn to drive at the same time with the same instructor. One person's inner belief about themselves is that they are capable and competent. The other carries a deeper belief that things will probably go wrong for them. Over years of driving, their records will diverge, not because of the rules they were taught, but because of how they apply those rules under stress. This is where most beginners make mistakes. They focus all of their energy on finding better strategies, better indicators, better information. They ignore the question of whether their own psychology is undermining even the best strategy they could find. Seikoda insisted that psychological work was not separate from trading work. It was the foundation of it. He founded what he called the Trading Tribe, a group of traders who met regularly not to discuss market strategies, but to work through the psychological patterns that were interfering with their trading. This was unusual, even radical, for a community of hard-nosed market professionals. But the results spoke for themselves. This is why this matters in real investing. You can read every investing book ever written and still underperform the market if your fear, your greed, your need for excitement, or your unconscious self-sabotage is running in the background. Working on your mind is not soft. It is the most practical thing an investor can do. Seikoda also had a beautiful way of describing the relationship between losses and growth. He said that losing a trade is like paying for a good education. The money is gone, but if you learn the lesson, the tuition was well spent. If you do not learn the lesson, you will keep paying the same tuition over and over for the same course. If you are starting today, spend time understanding your own emotional relationship with money and with risk. Ask yourself honestly what winning means to you and what losing means to you. Notice whether your trading behavior seems designed to produce profits or whether it serves some other emotional purpose. That honest self-examination might be the most valuable investment you ever make. We move now from the world of individual trading into the world of market structure itself, into the thinking of people who understand not just how to trade markets, but how markets actually work at their most fundamental level. Chapter 13. Joe Ritchie, The Invisible Edge of Understanding Structure. Joe Ritchie built one of the most successful options market-making firms in Chicago, called Chicago Research and Trading. Market making is the business of providing liquidity to markets, being willing to both buy and sell at all times so that other participants can trade whenever they want to. The edge in market making does not come from predicting where prices will go. It comes from understanding the mathematics of options pricing and finding small, consistent inefficiencies that accumulate over thousands of trades into large profits. Ritchie was a deeply analytical thinker who approached markets more like a mathematician than a traditional trader. He was interested in the underlying logic of how options were priced, in the assumptions embedded in pricing models, and in the moments when the real world deviated from those theoretical models in exploitable ways. What is fascinating about his approach is how different it is from everything we have heard so far. Marcus, Kovner, Jones, and the others all made large directional bets, meaning they tried to profit from prices moving in a specific direction. Ritchie's approach was largely independent of direction. He profited from the structure of the market itself, from the mathematical relationships between different instruments and different time periods. Imagine a casino owner. The owner does not need to predict which way the roulette ball will fall. The casino profits from the structure of the game, from the mathematical edge built into every bet, regardless of the outcome. Ritchie built something similar in options markets. This is where most beginners make mistakes. They assume there is only one way to profit from markets, which is to buy low and sell high. In reality, there are multiple approaches to market profitability, each with its own logic, its own risk, and its own requirements. Understanding this broader landscape of approaches can help you identify which style fits your own temperament and skills. Ritchie also spoke about the importance of building and trusting rigorous systems rather than relying on intuition. In market making, the volume of decisions is too high for individual judgment on each one. You need a framework that you can apply consistently and that you have stress tested thoroughly before trusting with real capital. This is why this matters in real investing. Whether you are a systematic investor who follows rules mechanically or a more discretionary investor who exercises judgment, the key is having a clear, thought-through framework that you trust and apply consistently. Improvisation without a framework is just gambling. If you are starting today, think carefully about which approach to markets fits your personality and skills. Are you someone who enjoys deep analysis and is comfortable holding positions for long periods? Are you someone who prefers high frequency, small margin opportunities? Are you a macro thinker or a bottom-up stock picker? Understanding yourself is the beginning of finding your edge. Chapter 14. Jim Rogers, the contrarian who circumnavigated the globe. Jim Rogers co-founded the Quantum Fund with George Soros, one of the most successful investment partnerships in financial history. During the 1970s, the Quantum Fund returned over 4,000%, while the broader market returned under 50%. Those numbers are almost incomprehensible. But Rogers is in many ways the most unusual person in this entire book. After leaving the Quantum Fund, he literally traveled around the world on a motorcycle, and later by car, exploring markets and economies in person in a way that almost no investor had ever done. He wrote books about what he found. He talked to farmers, factory workers, government officials, and merchants in dozens of countries. And then, he invested based on what he saw. His approach to investing is grounded in one fundamental principle: own things that are cheap and where the underlying reality is improving. Sell things that are expensive and where the underlying reality is deteriorating. This sounds obvious, but the application requires seeing the underlying reality before it becomes obvious to the market. Rogers was famous for finding investments in countries and commodities that were so unfashionable, so neglected, so universally ignored by professional investors that their prices had fallen to levels that bore no relationship to their actual long-term value. He would then buy and hold, sometimes for years, until the market eventually recognized what he had seen. This is the ultimate expression of contrarian investing. Not just disagreeing with the popular view about whether a stock is overvalued, but being willing to invest in entire countries and asset classes that the investment community has completely given up on. Imagine someone walking through a flea market early in the morning before the crowds arrive. Among the piles of junk, they find an original painting by a significant artist, priced as if it were worthless. Most people walk past it because they do not know what they are looking at. The one person who recognizes it quietly pays the asking price and walks away with something extraordinary. Rogers was that person in markets. This is where most beginners make mistakes. They only look at what is popular, what is performing well recently, what is on the front page of financial news. The investments that most excite the crowd are usually the ones that have already seen most of their gains. The ones that offer the best forward returns are usually found in the places where no one is looking. Rogers also spoke about the critical importance of doing your own research. He distrusted the conventional financial world, the banks, the brokerages, the analysts, not because they were dishonest necessarily, but because they had structural incentives that often did not align with the interests of individual investors. He preferred to go directly to the source, to visit the farms, the mines, the factories, and the marketplaces of the world, and form his own independent judgments. This is why this matters in real investing. Independence of thought is one of the most valuable qualities an investor can cultivate. Not independence for its own sake, but the kind that comes from doing the work to form your own well-founded view, rather than simply following the herd. If you are starting today, develop the habit of looking at what is out of favor, unloved, and undervalued, rather than what is exciting and already moving. The best opportunities are rarely the ones everyone is talking about, They are the ones everyone has forgotten. We have now traveled across futures markets, stock markets, trading pits, and global economies. We have met traders of every style and background, and in everything they have shared, one theme keeps returning. The mind matters more than the method. It is fitting, then, that our final chapter is dedicated entirely to the psychology of trading and investing. And the person who will guide us through it has spent his career studying not markets, but the people who participate in them. Chapter 15. Dr. Van K. Tharp. The map is not the territory. Dr. Van Tharp is different from everyone else in this book. He is not a trader. He is a psychologist who has spent decades working with traders to help them understand and overcome the mental obstacles that prevent them from performing at their best. His core insight is both simple and radical. He argues that the market does not exist as an objective reality that we interact with directly. We each trade our beliefs about the market, not the market itself. Every trade you make is an expression of a belief, a mental model you hold about how markets work and what will happen next. This might sound philosophical and distant from the practical reality of buying and selling, but its implications are enormous. If you are trading your beliefs, then the quality of your trading is directly determined by the quality of your beliefs. And the first step to improving your trading is not to find a better strategy, but to examine and improve the belief system that underlies your decisions. Consider two investors who both use the same strategy. One believes, at a deep level, that markets are rational and that their analysis is likely to be correct. The other believes, also at a deep level, that markets are unpredictable and that they personally tend to get unlucky at critical moments. These two investors will make the same trades with very different results because their beliefs will lead them to execute those trades with different levels of confidence, patience, and consistency. Imagine two musicians playing the same piece of music. The notes are identical, but one plays with confidence and presence, while the other plays with anxiety and self-doubt. The piece sounds completely different. Markets are like that. The strategy is the notes. The psychology is the performance. This is where most beginners make mistakes. They assume that finding the right strategy is the main challenge. In reality, for most investors, the main challenge is executing even a mediocre strategy with enough consistency and discipline to produce positive results. Psychology determines execution. Execution determines results. Tharp developed what he called a position sizing model based on the concept of R multiples. R stands for the initial risk on a trade, the amount you would lose if the trade went against you and you hit your stop loss. Every trade is then measured, not in dollars of profit or loss, but in multiples of that initial risk. A trade that earns twice your initial risk is called 2R. A trade that loses your initial risk is called minus 1R. The beauty of thinking in R multiples is that it separates the quality of a trade from the size of the profit or loss. A small trade that earns 10R is a better quality trade than a large trade that earns 2R because the ratio of reward to risk is far more favorable. This framework allows you to evaluate your trading independently of the dollar amounts involved and see clearly whether your strategy is producing positive expectancy over time. Positive expectancy means that on average, across all your trades, you make more than you lose. A system with positive expectancy will always produce profits over a large enough sample of trades, even if many individual trades are losers. A system with negative expectancy will always produce losses, even if some individual trades are large winners. This is why this matters in real investing. Most investors evaluate their performance by looking at whether their last few trades made or lost money. Tharp argues that this is completely the wrong way to evaluate a trading strategy. You need a large enough sample to see the true expectancy of your system, and you need to think in terms of risk-adjusted returns rather than raw dollar amounts. Tharp also spoke extensively about the concept of expectancy combined with position sizing as the two main drivers of long-term investment performance. Given two investors with the same edge, the one with superior position sizing will always outperform over time. This is a mathematical reality that most investors simply ignore. He also addressed directly the issue of financial beliefs that most people carry without ever examining. Many people have deep, unconscious beliefs that money is scarce, that wealth is undeserved, that markets are designed to take money from ordinary people and give it to the privileged. These beliefs act as invisible barriers to investment success. They cause people to sabotage their own winning trades, to take on too much risk at the wrong times, or to give up entirely after a period of losses. Tharp believed that working on these deep beliefs was not just personal development work, it was essential professional development for anyone serious about investing. The investor who understands their own psychological landscape has an edge over the one who is being driven by unconscious patterns they have never examined. If you are starting today, take time to write down your beliefs about money and markets. Ask yourself where those beliefs came from. Ask whether they are actually true or whether they are simply stories you have absorbed from your environment. Then, ask which of those beliefs is helping you invest well and which ones might be holding you back. The journey through the minds of these 15 extraordinary market participants is now complete. But before we close, it is worth stepping back and looking at what they all shared. Conclusion: the common thread. Michael Marcus cut losses without hesitation and held winners with patience. Bruce Kovner controlled risk before anything else and stayed open to changing his mind. Richard Dennis proved that a disciplined system could produce extraordinary results for anyone willing to follow it. Paul Tudor Jones protected capital above all else and was willing to be contrarian at the most dangerous moments. Gary Bielfeldt sat with winning positions through the noise and waited for large moves to develop fully. Michael Steinhardt looked for the gap between consensus and reality and traded that gap with conviction. William O'Neill built a rigorous system from historical evidence and trusted it over intuition. David Ryan combined systematic selection with precise timing and ruthless loss control. Marty Schwartz listened to the market instead of arguing with it. Tom Baldwin acted instantly and without fear in the most stressful environment imaginable. Tony Saliba built mastery through deliberate small steps before scaling to large positions. Ed Seykota understood that the market reflects the investor's psychology more than any external reality. Joe Ritchie exploited the mathematical structure of markets systematically and without emotional attachment. Jim Rogers saw the world directly and invested in neglected realities before they became fashionable. And Van Tharp showed us that the mind is the market we most need to master. What does all of this mean for you? It means that there is no single correct strategy. There is no one path to investment success. What matters is that you find an approach that fits your personality, your temperament, and your strengths. That you develop genuine understanding rather than borrowed opinions. That you manage risk as your primary job and let returns take care of themselves. It means that your mind is your most important trading tool, more important than any chart, any indicator, any financial model. The investor who understands themselves will always outperform the investor who only understands markets. And it means that patience, more than brilliance, is the quality that creates lasting wealth. The ability to wait for the right moment, to hold through discomfort, to stay in the game long enough for compounding to do its work, is available to every investor regardless of their background, their education, or their circumstances. The wizards of this book were not born with magical gifts. They built something extraordinary through years of honest learning, disciplined application, and the courage to keep going when markets punish them. You can do the same. The journey begins with the very next decision you make.